Financial institutions of all types have been making the news lately with the debate over so-called environmental, social, and governance standards, or ESG. But what is the difference between some of the biggest players in this space, namely asset managers, banks, and proxy advisors? And what role do they play in the ESG discussion? An asset manager manages money on behalf of individuals, companies, and even governments and public funds. The client gives asset managers parameters of where they want their investments to go, and asset managers have a fiduciary responsibility to act in their clients' best interests. Listening to their clients' wants, asset managers have increasingly given their clients more choices to manage investments and even provided opportunities for some clients to vote their own shares. Banks play a different but significant role in the economy. Banks review and provide capital through direct investments, loans, or bonds to businesses for several reasons, but are increasingly looking at ESG-associated risks and opportunities before making decisions to provide capital. Proxy advisory firms review corporate board proposals and votes, especially those dealing with ESG issues, and provide recommendations to their clients, often large institutional investors, on how to vote their shares during proxy season. While there are 5 leading proxy advisory firms in the US, 2 firms dominate roughly 97% of the market. Their outsized role in advising clients on how to vote on corporate board issues has led to recent criticism of their ability to influence significant voting blocks on contentious topics. Often, institutional investors will automatically vote in line with how these firms advised, with no regard to individual investor preferences. Bottom line, asset managers manage funds on behalf of their clients, according to the client's wishes, with their best interests top of mind. By and large, they aren't directing investments, just following the client's preferences on where to invest and how to vote. Banks lend money and inject capital into businesses after determining whether a specific business meets their criteria, including how the bank views ESG-related risks. And proxy advisors review and provide recommendations on how to vote, at times directing votes on behalf of investors on hot-button issues facing corporations. While all of these entities have some exposure dealing with the high-profile ESG debate, it is important to understand the differences between each and how they're involved in dealing with these issues.